Hello and welcome to Morning Brief Market Sunrise. It's Friday, 15th August. Coming up on the show, President Trump and President Putin meet for the first time in 7 years in an attempt to find a resolution to the war in Ukraine. Intel stock is surging in the pre-market on a report that the Trump administration is thinking of taking a stake in the chip maker. And just why has Berkshire Hathaway bought UnitedHealth shares but sold Apple ones? So grab your coffee and let's own the morning. We kick off the things you need to know in Asia. Well, there's been some pretty big moves in the markets there, but overall, we've had some pretty mixed signals from the region as well. The Nikkei in Japan rose to another record high after the country's Q2 GDP grew at 0.3%, which was better than expected. But the Hang Seng in Hong Kong fell almost 1%. Now, China's economy showed signs of slowing in July as factory output and retail sales slowed and housing prices dropped further. That's according to data that was out today. Uncertainty over tariffs on exports to the United States is still looming over the world's second largest economy after President Trump extended a pause in sharp hikes in import duties for another 90 days beginning Monday. Interestingly, the Shanghai Composite, the main index in the mainland, rose today. OK, the next thing to know about is how the markets stand before the opening bell rings and those crucial talks between Russia and the US take place at 3 p.m. Eastern. In the main, it's looking like Wall Street will open just about on the front foot after a pretty subdued trading session yesterday. Russian President Vladimir Putin has sought to strengthen his rapport with Donald Trump ahead of their summit, praising the US leader's efforts to broker an end to the war in Ukraine and dangling the promise of economic cooperation as well as a new arms control treaty. Trump, though, has sought to dial back hopes for a breakthrough. He's also had to reassure allies on a call on Wednesday that he won't negotiate the swap of territories at the summit. And finally today, on the economic front, the focus will be the retail sales data. The results should give us more clues as to whether Trump's tariffs are impacting consumer spending habits. Economists expect government data to show a solid increase in July, retail sales driven by incentives that boosted vehicles purchases and a surge in online spending during Amazon's Prime Day event. Yesterday, we found out that July's Producer Prices Index, PPI, came in hotter than expected, and that may have added doubts over a Fed rate cut next month. And one economist, speaking to my colleague Josh Lipton, believes the threat of inflation hasn't gone away.
We've already seen building pressure, especially on the PPI side of things. The Consumer Price Index, we expect that one to start turning up very soon as well. We're starting to see more of these inflationary pressures, fundamental factors that have been in place for years now across the economy, just starting to impact inflation. And I want to be absolutely clear, when I talk about these fundamental factors, I don't just mean tariffs. There are a lot of other pressures, both fiscal, monetary. We see higher wage pressures. We see higher electrical, energy costs building in. So I think this is a much broader conversation. I still don't think we've seen the full impact from tariffs just yet.
And so, Lauren, now that you as an economist, you got your CPI, you got your PPI, what are you expecting for core PCE, which of course is Jay Powell's preferred inflation gauge?
Yes, so there's going to be some differences between those two, just methodologically speaking, but we do see the general direction typically align. Again, these are broad-based inflationary pressures that we're seeing just now. I see more reason for rates to be rising in order to not let inflation get away from us as it did the prior cycle, than to see these rate cuts. So I think the Fed is watching very closely the movement beneath the surface. Yes, we might get a 25, maybe 50 basis points. I struggle to even see 75 this fall because more broadly speaking, inflation is the risk that's on our doorstep, much more so than the labor market. The Fed officials know that.
And the big market mover you need to know about is Intel. The American chip maker is hitting the headlines, and once again, the White House is right there with it. Bloomberg first reported that the Trump administration is weighing a direct equity stake in Intel, further blurring the lines between government and tech giants. Intel shares jumped on the headlines, up more than 8% at one point, and as you can see, they're still going up in pre-market. Even though it isn't yet clear what the details of a deal with the White House will be and what will be the strings attached to it, for a company that's already been struggling to deliver on its earlier commitments to manufacture more advanced chips in the US. Beyond Intel, this is the latest sign of the US government's deeper intervention in the chip sector. Just in recent days, the Trump administration allowed Nvidia and AMD to go ahead with limited exports of AI chips to China in exchange for a 15% cut to the US government. That sets a precedent. Washington isn't just regulating its revenue sharing on strategic tech. Think of it as a sort of export tax designed to gain more control in American tech companies while also benefiting from demand from China. For Intel, which has been struggling, it could be a bit of a double-edged sword. A government stake could de-risk debt and factory building, but it raises questions about political interference and governance. Remember, Trump had previously called for the dismissal of the Intel CEO, but drastically changed tone after their latest meeting at the White House. Bottom line, chips are becoming more politicized, and we don't know yet what that will mean for a sector with sky-high valuations. That's driven US and global markets to new records. So the stakes, well, they couldn't be any higher. Right, that's it for market movers. It's time for a break now, but stick around to hear which semiconductor company shares are tumbling in the pre-market. Okay, welcome back. Now it's time to hear from my colleague Jared Blickery, who answers the question, should you buy the rip or buy the dip?
Stocks are on a tear once again. The S&P 500 just notched its 17th record closing high of 2025, and it seemed like a good time to answer a very basic question in today's Stocks in Translation. Which is the better investment strategy, buying the rip or buying the dip? So first of all, I started off by creating a chart here. I went all the way back to 1960 to get over 60 years of market history in the S&P 500, and I ran a study to see what the stats were if you were to buy every single all-time high in the S&P 500, all 1,100 of them, and then I compared that to buying every new one-year low or 52-week low, all 500 of them. Then finally, to have a baseline, I measured the results of buying every single day, all 16,000 of them plus, and guess what? For returns or performance, first of all, this is what we're showing in this chart. It is the median, which is very similar to an average, but you don't have it as exposed to outliers as much. So first of all, what if you were to buy every new high and hold for 1 week, 1 month, 1 quarter, 6 months, 1 year? That's what we're seeing in white. And so for some of the lower time frames, there's really not a lot of juice to be gained out of those. You can actually see that buying new lows was a slightly better strategy for 1 month out, but when you get to 1 quarter here and 6 months out, it's not a very good strategy at all. In fact, you want to be buying the highs if you're just an intermediate term holder there. Once you get to 1 year, the results improve dramatically. Just in terms of median returns, we're looking at about 10% plus, and you can see actually that buying new lows produces slightly better results. Now, the actual returns and what we're looking at here in median returns is not the only metric you want to consider. You also want to consider the hit rate, the win rate, or percent positive. And that's what I'm presenting here. So this scale goes from 40 to 80%. Nothing even approaches 100% or goes below 40. So at 1 week, 1 month, we're seeing pretty break-even results there, or neck and neck results, I should say. Then at 1 quarter and 6 months, these are the 2 time frames where buying the new lows, buying the dips wasn't the greatest strategy. Those have pretty bad percent positive statistics there. But then once again, once you get to the 1 year mark, you have pretty similar results between buying the new highs and buying the new lows. And compared to the baseline, there's not much of a difference between them. So I decided to go back to the drawing board, and I actually extended the study to include not only 1 year, but 2 years and 3 years out. So this is looking at the median returns again. How much are you going to see in your account? Now, 1 year, we already saw those results, but I left them in there so you can compare to what happens to 2 and 3 years. What's interesting is that buying new lows is a much better strategy in terms of returns once you go 2 years out and also 3 years out. Although buying the highs kind of comes a little bit closer to those buying the new lows once you go 3 years out. And it's neck and neck with that benchmark, which is buying every single day. Now, if we take a look at percent positive, we can see the results don't vary that much over the long term. So for 1 year, we're looking at percent positive of about 75% here. 2 years out, everything's neck and neck. That approaches 80. And then at 3 years out, we're a bit above 80%. What I didn't show here was the volatility. And if you take a look at the volatility that we experience in some of these studies over the short term, let's say 1 week up to 1 year, you have a lot more volatility if you're buying the dips. And that's not surprising. Bull markets are boring. And so when you're buying the highs, you're not experiencing a lot of volatility on those results. But when you're buying the lows, it's easier to get shaken out. So if you don't have a stomach for all that volatility, you might not want to be buying all those lows. But to conclude, I found some interesting things in here. Buying the dip tends to deliver the best returns overall. And then if you go up to 2 years out, buying new highs, that wins more. That's that percent positive that we were talking about. And then in the short term, buying the dip can be a bit bumpy, and that speaks as to the volatility I was just speaking about. And finally, the best strategy for holding long term, that's 3 years and out, buying the dip is the best.
And that's great analysis there from Jared. Stay tuned to Market Sunrise to get the latest on our trending stocks, including one West Coast tech firm down 10% in the pre-market. I'll be right back. Welcome back. Well, let's kick off our trending tickers. We're seeing several stocks in the red this morning. We start with Applied Materials, which is suffering from uncertainty in China, its largest market, and investors' nervousness in this uncertain geopolitical environment. You can see it here. The stock of the semiconductor company is tumbling. It's plunged nearly 15% at one point in pre-market. And as you can see, just over 14% down right now. Applied Materials reported strong Q3 earnings with revenue beating estimates at $7.3 billion, but issued a downbeat forecast due to challenges in China. The company's outlook suggests a potential 4.9% year-over-year revenue decline next quarter. This is a clear barometer of investor sentiment. With the current sky-high valuations, any negative signs in the AI and tech space can trigger massive market moves. Now, on a similar note, here's another ticker that's falling right now. SanDisk, the Californian maker of flash memory cards, plunged over 10% in pre-market action. Again, just like Applied Materials, its earnings beat appear to tell a positive story on the surface, with revenue at $1.9 billion above expectations and upbeat guidance. But the softer margin guidance rattled investors who seemed more concerned with SanDisk's near-term profitability, as the competition in the data storage space is high, and that means lower pricing power. Once again, there had been some enthusiasm about this company as it recently spun off from Western Digital, and it's expected to benefit from the AI boom and its data storage needs. But not today. One small detail was enough to spook off investors. It's definitely a jittery market out there. Okay, we've got some breaking news for you now with a company we don't hear about that often, but that's worth your attention this morning. US baking giant Flowers Food shares are set to tumble again after earnings came in. Revenue actually came in at $1.24 billion. That was below the expected $1.27 billion. And the company has cut its full year forecast as well. It's a company that's based out in Georgia. The company creates products such as Wonder Bread and Nature's Own and has a market cap of around $3.5 billion. Shares are down around 20% in value year to date, but they had recovered slightly in the past month as analysts were hoping for improvements. Now, direct rivals who have already reported, such as Fresh Del Monte and Vital Farms, have actually beaten expectations, but not Flowers Food, which had missed Wall Street estimate revenues 6 times over the last 2 years. Now that make that 7, and this report adds even more pressure. Well, that's it for trending tickers. Let's take a moment to hear from CoreWeave CEO Michael Intrator, who was interviewed yesterday on Yahoo Finance. The company posted its anticipated first earnings report following their successful IPO earlier in the year.
So our company is relied upon by the largest, most important consumers of compute in the world. It is the leading AI labs. It is the hyperscale clouds. It is the tech-forward enterprise clients. the folks that really require computing power to move their business forward. It's the people who are building the future and the companies that are building the future. And it's a privilege to be able to be one of a relatively small number of companies that are able to build infrastructure at this scale and of this quality that allows the artificial intelligence that will drive the world for the next 50 years to be built on our infrastructure. We're really excited about that position. We will continue to invest in that. We will continue to build for those clients that require it. And we will continue to scale the company and provide the large and expensive infrastructure that's required. It's a great business. The margins are great. We're able to really kind of move our company forward. We have chosen to use a model that relies upon more debt because we are a smaller company competing against very, very large companies, and we have accessed pools of capital that up to this point have never really been able to come to bear on the build out of technical infrastructure. They are in fact the backbone of building out every other type of infrastructure on the planet. If you buy and build power plants, these are the people you talk to. If you build airports, these are the people you talk to. And we believe that we have structured it correctly so that you can use those tools to build the computing infrastructure of the planet.
Mike, as you said, you work with the largest companies that are doing this, that are relying on your compute capacity. Some of your critics have also said perhaps you're over-indexed to a few large clients. What happens if those large clients say, well, we're going to bring all of our compute in-house, for example? What's the diversification strategy going forward?
So in the earnings call, I tried to really speak to this in a couple of different ways, right? First of all, it is the nature of this business that there are going to be large players that require large blocks of compute. There aren't going to be 300 foundation models. OpenAI and a few other important labs are going to build the foundation models that the world uses. And so it's a incredible privilege for us to be able to serve compute to the foundation model builders and the large clouds that are going to consume this compute at gargantuan scale. At the same time, we have brought on new clients every single month since we founded this company. Recently, we acquired a company called Weights and Bias, which extends our software offering. And that brought in an entire new tranche of clients like British Telecom. We have clients within the visual effects space like Moon Valley. We have clients in the healthcare space like Hippocratic AI. Like there are so many new clients that are joining and diversifying our revenue. There are so many new clients that are becoming dependent upon the infrastructure and the quality of the infrastructure that we provide. You know, we're going to have large clients. We're excited about those large clients. It makes it so that the contracts can be underwritten by the large lending institutions. It's really exciting to see that happen, but it's also exciting to see new clients come on and use our infrastructure as successfully as they have.
And Mike, finally, I want to ask you about Core Scientific. That's the big deal you guys are doing to get more ownership of the compute, the data center capacity. I'm just curious about how you think the chances are that it's going to get regulatory approval, if you see any risk to that.
Yeah, I don't see really any risk to the regulatory approval component of it. There are a lot of data center providers within the U.S. Core Scientific represents a data center provider. We have relationships with many, many of them. I think the regulatory component of this transaction is relatively straightforward. And I believe that we'll probably get a significant amount of support as we go through that. You always got to go through this stuff. You got to work through the system. You've got to present your case correctly. But I'm confident that from a regulatory perspective, we will not face any material challenges as we look to integrate the companies.
Well, today we're looking at Warren Buffett's Berkshire Hathaway's decision to sell Apple shares while adding UnitedHealth Group shares. Let's start with Apple. Berkshire sold 20 million shares of Apple in the June quarter, marking the first time it's reduced its stake in the consumer electronics giant since last year. Apple, though, still remains the company's largest holding. And remember, Buffett praised its chief executive officer, Tim Cook, at Berkshire's annual meeting just in May. Now, Apple shares recently traded about 30 times its projected earnings over the next 12 months. That's according to FactSet. And as you can see, the stock has slipped over 7% this year. Okay, let's move on to United Health now. And Berkshire has acquired 5 million shares, and that's had quite the impact in the pre-market. As you can see, shares there are up over 10%. Now, it was once a healthcare stalwart, but has struggled in the midst of a litany of challenges, including a pullback in Medicare funding, the shooting death of a top executive, and controversies over its business practices. In May, Chairman Stephen Hemsley returned to his former role as CEO to help engineer a turnaround. Now, United Health shares have lost more than 46% of their value this year alone. In fact, they've lost about half over the past year. The healthcare conglomerate has signalled prolonged pain with a new far lower profit forecast as it sees billions of additional costs in the upcoming quarters. Now, overall, though, Berkshire was a net seller of stocks in the second quarter, unloading $6.92 billion of equity securities while buying $3.9 billion. That's according to its financial statements. Now, it's continued to stockpile cash and has refrained from repurchasing its own shares in the midst of the market's recent record-breaking rally. The cash trove actually grew to $344 billion, including equivalents at the end of June. Okay, before we go, let's get a look at how the markets stand. We start with Bitcoin, and as you can see, starting to ease back off. It did hit 124,000 just yesterday in early Asia trade. It's now down below $120,000. The pullback seems to be related to that hotter than expected PPI data that we got yesterday, and that seems to have scared investors a little bit that perhaps the Fed might not be cutting rates next month, but though the markets are actually pricing in a 90% chance of that actually happening. Okay, let's move on to the Asian markets now. As I mentioned earlier, the Nikkei hitting another record high. The Hang Seng struggling there after some really poor data out of China. Though bizarrely, the mainland Shanghai Composite is up today. China's property sector in particular under pressure, as we can see as well. Let's move on to Europe too. And European shares are actually in a pretty good mood today. There's a bit of optimism surrounding the talks between President Putin and President Trump. They're hoping that there could be a resolution to the war in Ukraine, though President Trump himself has downplayed that and said that it's unlikely. This is just the first set of talks. He's planning other talks, possibly with President Zelensky and President Putin and even some European leaders, though he hasn't committed to that completely. It's worth noting, though, European shares are higher because of optimism surrounding those talks as well. Okay. And also next week, let's look at the US markets before we go as well. They were just about in the green on the main. The Dow Jones up 300 points, as you can see.